At the dawn of the new millennium, there was one company that was the absolute king of corporate America. Its name was Enron, and it just seemed like it could do no wrong. But behind that shiny curtain of innovation and record profits was a lie. A lie so massive it would shake the very foundations of Wall Street. Okay, let's dive into the incredible story of how this empire, built on pure deception, managed to fool the entire world. To really get the shock of Enron's collapse, you first have to understand just how big their reputation was. I mean, we are talking about a company that Fortune magazine crowned America's most innovative company for 6 years in a row. They were the darlings of the media, the innovators that everybody else wanted to be. And oh yeah, Wall Street absolutely adored them. At its peak, back in August of 2000, Enron's stock was flying high at over $90 a share. Investors, analysts, even their own employees were pouring their life savings into the company, believing it was a surefire ticket to wealth. But you know how these stories go. That dazzling success story was about to take a very, very dramatic and catastrophic turn. By the end of 2001, that same stock, remember, the one worth over $90 a share, was trading for just 26 cents. 26. The value had been completely and totally wiped out. This wasn't just a market correction. It was a corporate extinction event. So you've got to be asking yourself, right? How does a company reporting over $100 billion in revenue just disappear? How does an empire that looked totally invincible crumble into dust practically overnight? Well, that is the mystery we are going to unravel right now. To get to the answer, we've got to rewind all the way back to the beginning. Our story kicks off in 1985 with a guy named Kenneth Lay, who merged a couple of old-school natural gas pipeline companies. And in its early days, Enron was a pretty straightforward, almost boring business. But then, in the 1990s, everything changed. The U.S. government deregulated the energy markets, and suddenly, Enron's reliable, old business model was in serious trouble. They lost their exclusive rights to their pipelines and had to figure out a radical new way to make money, or risk becoming a dinosaur. And this is where a brilliant, and let's just say dangerous consultant from McKinsey named Jeffrey Skilling steps onto the scene. Skilling had this revolutionary idea. What if Enron stopped being a company that just owned physical stuff and instead became like a stock market, but for energy? He was about to completely rewrite Enron's DNA. So now we get to see how this new, brilliant vision became the very engine of Enron's deception. To make it happen, they had to start bending the rules of accounting, and pretty soon, the rules of reality itself. The first key to the whole scheme was a technique called mark-to-market accounting. Now, believe it or not, this was actually a legal accounting method. It allowed Enron to sign, say, a 20-year deal, and then immediately book all of the projected profits from that entire deal as real revenue right then and there, even if they hadn't seen a single dollar of actual cash yet. And this slide really nails the concept. Think of it like a financial magic trick. Enron could sell the idea of future money to Wall Street as if it was cold, hard cash sitting in the bank today. It let them create this complete fantasy of endless, skyrocketing growth. Now, inside the company, Skilling created this absolutely brutal culture to match their aggressive accounting. He brought in a system called rank and yank. Can you imagine this? Every single year, the bottom 15% of employees were just fired. No questions asked. This created a super toxic environment where no one, and I mean no one, dared to admit a project was failing because that meant you were next out the door. Honesty became a fireable offense. But here's the thing. Mark-to-market accounting could create fake profits, but it couldn't hide the very real losses from all the deals that were failing. To solve that problem, they needed a different kind of genius. A man who could literally make billions of dollars of debt disappear. And that man was Andrew Fastow, Enron's chief financial officer. Fastow's big idea was something called a special purpose entity, or SPE for short. You can think of them as ghost corporations. I mean, they were basically shell companies that only existed on paper. Enron would sell all its bad deals and toxic debt to these SPEs, and just like that, the debt would vanish from Enron's official books, making the company look incredibly profitable and healthy to investors. And the scale of this whole thing is just, it's staggering. We're not talking about a few shady shell companies. Look at this number. Fastow's team created over 3,500 of these entities. 3,500. This was an industrial-scale operation designed to manufacture a perfect-looking company.
But you know what they say, an empire built on lies can't last forever. Now we're going to see how the first tiny cracks started to appear in Enron's facade, right before the entire structure came crashing down with unbelievable speed. The first big warning actually came from the inside. In August 2001, a vice president named Sharon Watkins sent this memo directly to the CEO, Kenneth Lay, basically warning him that the company was a house of cards and that it was going to implode. And what happened? Her warning was completely and totally ignored. And then it all began to fall apart. And it happened so fast. That same month, August 2001, Jeffrey Skilling suddenly quit. By October, the company reported a massive $638 million loss. In November, their credit rating was officially downgraded to junk status. And just a few days after that, on December 2nd, it was all over. Enron filed for what was then the largest bankruptcy in U.S. history.
The fallout was just devastating. This chart really shows you the staggering human cost. Shareholders lost an estimated $74 billion, just gone. At the same time, over 20,000 employees didn't just lose their jobs, they lost their life savings, which were all tied up in worthless Enron stock. And while all this was happening, the top executives had quietly cashed out millions for themselves before the whole ship went down. In the wake of all that devastation, the world demanded answers, and it demanded justice. The collapse kicked off one of the most complicated white-collar crime investigations the FBI had ever seen, and it was aimed squarely at the architects of the whole fraud. And for the most part, justice was served. Kenneth Lay, the CEO, was convicted, but actually died before he could be sentenced. Jeffrey Skilling, the mastermind, served 12 years in federal prison. And Andrew Fastow, the architect of all those shell companies, he cooperated with prosecutors and ended up serving 6 years. But the impact of this scandal went way beyond the courtroom. To try and prevent another Enron from ever happening again, Congress passed the Sarbanes-Oxley Act in 2002. This was landmark legislation. It created sweeping new standards for how companies are run and how they do their accounting, and it changed the rules for public companies forever. And that kind of brings us full circle, doesn't it? The Enron scandal gave us new laws and new regulations to protect us. But the story of Enron wasn't just about accounting tricks. It was about a culture of greed and a win-at-all-costs mentality. And so the real question remains, more than 2 decades later, has that fundamental culture, has it really changed?